Welcome back. You're watching us here on this very special conversation that we're having with the young guns of the street, gentlemen and ladies who are known to identify themes young and then watch them grow their portfolios and grow the portfolio investments of all those who have invested with them. We have Vikas, Amit, Ravi and Roshi and Rashi with us as well. Amit, we're talking about individual stock journeys. You know, the one that has blown everyone's minds over the last 2 or 3 years is Trent. The way they captured everyone's imagination with Zudio. Earlier, it was feared to be margin dilutive to their West Side business, and now suddenly that's become the growth driver. It's all the way everyone is now betting on the lab-grown piece as well. How did you identify Trent, and when did you decide to, enter? What exactly was the story like?
So Mangalam, we're just looking at every company possible. We don't miss out all 4,000-5,000 companies. We don't miss out even one quarterly result. That's the first basic thing that we do. We keep looking and we divide industries, that who's in every industry, who's that player, who's the rock star of that industry. We had pain, and we have a 25 stock portfolio. So there is always 5-7 stocks in my portfolio who are struggling. Like today, I'm struggling in a airline company. I'm cutting some weight, down 20%, but it's okay. I'm buying something else, 20% down. Everything is down 20% now. So if you're cutting something, you're also buying something down. You want at any point of time your portfolio to be the best performing companies. And you need visibility. See, I don't have a 10-year visibility. I have maximum 4 to 6 quarters of visibility. And I am only thinking, for me, terminal value is 6-8 quarters. Like, of course, I think about, because we buy market leaders and beyond. But we think that beyond that rate of... It's
exact opposite to the person on your left.
No, of course. Right? We think long-term, short-term, medium-term, everything. Because if
so he's a sprinter, jumper and a marathoner. please tell us.
See, that's why we buy a DMart. You can have DMart for 20 years also. You can have DMart for 6 quarters also. But so we keep looking at options and available options because we have to invest. And Trent.
Yeah.
We initially bought Trent pre-COVID, to be honest, at 600 rupees.
What did you see there?
That time we were seeing West Side had the highest like-to-like growth.
Okay.
We didn't know Zudio will come.
Yeah.
And then COVID happened. We sold Trent. We lost 20% and we bought some pharma stock.
Okay.
We made money in the pharma stock. I'm telling you the real story. Because we made money we were buying Dr. Lal and Metropolis because we could see tailwinds in Metropolis and Dr. Lal that time in COVID, and we couldn't see when the malls opened.
Yeah.
From 600, we bought Trent again at 1200 after 2-3 years. So we are unemotional towards our investments. We are just thinking that what next is going to have those tailwinds of high growth. We were selling DMart, emotional less. It was my first holding. It was the only stock we've held for 5 years in the fund.
I would like to be on the road with him once, and when there are like those toll booths, there are 5 or 6 of them, I will ensure that his car is the one which goes through that toll booth first, or those airport queues as well, because he's just the one who's...
No, I think that's another very, very important lesson, being emotionless. Not letting your ego get in the way, or your attachment with one stock. Oh, I saw this story and I will see it through the end. So I think having a little bit of disengagement at a level, I think is also important. So we've taken that point on board. Now I want to come to Ravi. And Ravi, you made a really important point, right? So today, like if you ask me, it's a no-brainer. Of course, you have to be in stocks which are in renewables. Obviously, you have to play energy transition. Of course, you want to be in the semiconductor space. But that doesn't make me Ravi Dharamshi, right? The magic is in picking the companies within that space. So then explain to us, how do you do it? I mean, whether it was HAL in defense, whether you picked Hitachi, I think, to play this whole energy space. What goes into the tier 2, tier 3 filtering?
No, so let me just spend a couple of minutes explaining why energy transition. It's not like energy transition came about today. Humans have been going from one source of energy to another source of energy over a period of time. But this is the first time that we are moving away from all our sources of energy have been natural till now. We dig ground or we burn gas or whatever it is. But this is the first time that we are moving towards a manufactured source. Essentially, energy will be, of course, we are catching the energy from either from wind or from solar. But the industry that will benefit is the manufacturing industry over there. In 2019, we had COP27, where till then there was no consensus in the world regarding whether there is global warming, what should we do about it. But that was the point at which 90% of the world agreed that we need to restrict the increase in temperatures to less than 1.5 degree by 2050. Now, if that is going to be the case, and finally we had regulators, governments, non-government, commercial enterprises, individuals, everyone aligned to the fact that we need to bring the greenhouse gas emissions down. Now, this is what gave the impetus, and this was the trigger that, okay, now a lot of money is going to flow in this direction. Which are the businesses that can benefit out of it? And if I were to lay out the energy transition, it's energy generation, transmission, and consumption. And on top of that, of course, there are finances and new technology that will develop. But in energy, there are sources like solar, wind, nuclear, biofuel. In the at the end, in the consumption, there is electrification of everything. We talk about EVs as a trend, but EVs, there is two-wheelers, CVs, three-wheelers, buses. There are many segments. In the power transmission, of course, it's like if you're going to start selling cars, you need to first have the roads in place. Unless we have our power transmission in place, we are not going to be able to transition away from fossil fuels, which is a much more stable source of energy, to renewables, which is far more variable and infrequent.
Sure.
So we need to have power transmission, which is a grid which is far more flexible, efficient, much larger and effective. So this is how we looked at the entire space. And when you saw that, what we realized is, as I mentioned, that a trend can play out over a 20-30 year period, but which is the immediate sector that will benefit.
Correct.
And that's where the power transmission fits in. That we need to build this power grids in the next 7, 8, 10 years for us to ensure that we move towards the renewables. And when you see, this is one space where there is no Chinese competition. There is no Chinese technology. On the power generation side, on the renewable side, it's completely dominated by Chinese. But in the power transmission, it's still all European technologies, and there are very few players in every segment. There are 3, 4, 5 players at max. So you are going to see a big delta in terms of opportunity, and that delta is going to be captured by few companies, and there are some companies that have a right to win over there. And that is our formula for picking any company. And whether it is Hitachi in energy transition's case, and or with disclaimer, of course, we still continue to hold Hitachi. Okay. But above 765 kV, there is only, Hitachi has almost 65-70% kind of a market share in transformers. And when we bought it, of course, the earnings were depressed, and that's why the multiple looked very, very high. A lot of people thought that 100p multiple stock, but essentially, you had to look at, this company is potentially going to get anywhere between 25 and 50,000 crore kinds of order in the next 3-year horizon. Sure. And it is available at a 15,000 crore market cap when we bought it. And where the earnings, margins, everything is subdued. So it was actually a no-brainer to me. Of course, I was still, the execution still remains ahead of us, and we could see further some quarters where the delivery doesn't come through. So always the mind is prepared that if the stock corrects more, we will be buying more instead of getting worried about.
It's a long-term call, so you won't bother about the
5-7 year story that we are talking about, and 1-2 quarters here and there can definitely be
just
an
the
issue.
thing that stands between both of them, and I'm sure is common to all of them, is the sheer hard work that they're doing when it comes to the research. It's very easy to just come out and talk about one of these ideas that have been very successful for all of you all, or the ones which haven't worked. What one can't take away is from you all is the kind of research that he's doing, the macro research that he did on the entire space, the renewable space, or any theme that he's backing, or the fact that you look at each company's quarterly result. That's nearly 5,000 companies, 4 quarters, 20,000 earnings sheets that you're looking at every year. That is something that Vikas spoke about earlier as well. That if you want to make quality returns, you have to do quality work as well, and at the same time you have to be willing to see what no one else is seeing. Be it ICICI Bank in 2019, when no one else was seeing. What was it? So I just want to understand, what is your input that allows you to see what no one else is seeing? Because when you said that, the narrative is a certain thing, whereas the rate of change is something else. Be it ICICI Bank, be it the Atmanirbhar Bharat segment, be it the manufacturing companies, what is it that you saw at that point in time, but the narrative was completely against? So can you give us that secret?
No, sure. I think first of all, when you have to take a call against the common narrative, one thing which is required is your conviction and the courage to act on that. Because when you go wrong, you're going against the sort of common narrative. So, and that requires deeper work, deeper understanding of a lot of things. So, one of the things which you always look, like since you referred ICICI Bank, I think everybody said ICICI Bank is a dud, nobody creates. But I think what market missed is a change in the leadership. See, it's a good brand, good balance sheet, good technology platform, a decent, large player. But in every organization, change of leadership brings a new energy, new drive, new. So what missed was the change of the leadership and what that leadership could achieve in a very short period of time. And when we spent time across various levels of the management, we figured out that there was a very big change in the culture and strategy which has already taken place, which is not noticed by the market. Market was still going by the narrative, asset quality, still no poor ROE, poor. But that change was what goes in, takes time, few quarters to reflect. And when nobody's buying, you are getting right price. So at one time book we bought, it was like I think sub 300 levels. Today, in 5 years time, 2.6. It's, it used to be cheapest stock. Today it is probably most expensive stocks in the banking sector.
Yeah.
And as more and more people figure this out, that leads to re-rating. So one of the big theme which I have is that big money is made when you capture both earnings growth and valuation re-rating.
Right.
That's where you big money, whether to find out an sectoral theme early or a change in the company early, and that is what plays out. But it requires a lot of work connecting the dots. Same way, manufacturing, everybody was common narrative that it can't do well. But when we spoke to 30, 40 companies, everybody in their own way was communicating something different, that something is changing. And we said, government is trying to do, China Plus is working out. We spoke to some consultant, McKinsey kind of people to figure out what's happening globally. And that gives us the confidence that this is here to stay. This is here to stay for a very long time. And when you have something trend which is here to stay for a very long time, then you go all in and you really take sizable bets. You could have bought few stocks, but then the reason why we launched a separate strategy is because our conviction was so high, right? And other thing I would just say that probably money gets made when you stay for a very long time. Another example I would give you, there's typically, many good managements go through bad business cycles.
Yeah.
And in those situations, if you can identify those change in the cycle, like I remember 2012-13, there was a company called KEI. The total market cap was 75 crores. And market had written that company off. But management quality, was great. I mean, I've seen the only company which didn't default in cable industry, despite that bad times and all, and nicely transitioned the company from industrial to consumer side. Market completely missed that. But you know what? If you remain stayed invested, so when I bought it was 75 crore market cap. Today I think it's 35,000 crore market cap. It's only 10, 12 years. And in this period of 10, 12 years, I can tell you many periods of 30% drawdowns have happened. If you don't have conviction around those management and the business quality, in those drawdowns you will give away. But if you have to make supernormal return, those few quarters of bad cycle or industry, you have to withstand. But that requires again conviction in the management and the business model, and that requires work and
you have to apply yourself absolutely and look at all the granular smaller details, which kind of resonates with what Rashi said earlier, right? Look for dislocations.
Yeah.
So Rashi, part A of my question is that typically is that say a slightly higher risk strategy than simply playing momentum, simply playing where the numbers are, where the growth is, because it's clean, you can see it right there, right? It lasts till it lasts. So is this a little more evolved for the more sort of complex investor? And then give us examples, because with dislocations, you can be right or you can be horribly wrong. So what kind of dislocations do you see opportunity in?
So I think that's a really good question. And I think what you need to do is break up return, right? So we have a risk neutral position. We have the beta of the market and we have the alpha of the market. So I clearly operate in the alpha portion of the market, which is the mispricing.
Okay.
To me, and correct me if I'm wrong, but I believe the normal growth strategies, the momentum strategies operate in the beta side of what your risk return is. So yes, it is slightly, you have to know your companies extremely well. You have to know when to cut back, because your, theory or investment philosophy in the company is not playing out.
Yeah.
So I'll just give you an example. Back in 2022, when oil hit 130, the last time that it hit 130, I think the general agreement and conviction was that at 130, the world will slow down. At that price, it's just generally not a price that the world can operate at the growth levels.
This is the Ukraine war time.
Yeah. Now, did I expect oil to come down to 75? No, but we were it should come down to between 95 and 100, be a more comfortable space for the world to operate in. Now, that's when we look for which companies go through the highest price dislocation because oil is at 130. So these are all oil ones which use oil as a commodity, right? So whether it's in the airlines,
tires, airlines,
Indigo, Apollo Tires, Fiat. We found the highest price dislocation amongst these companies. We found that at a normalized oil price, the price should be much higher for each of these companies. And if you looked at Apollo Tires, so I remember somebody telling me on the sell side that, it's trading at 40 times earnings. I said, yeah, but there's no E. Right? So that's the key part. You can't look at it for that. And we bought all three. We played it through to when oil was down to 80, and we made our money on it. And again, it sounds like this happens in 3 months. It doesn't, right? It takes 6 to 8 quarters to play out the way you want it to. At the point when we did sell Apollo Tires, and even today, the P is 13. So from 35 to 13, you've seen the earnings expand per se, and that price dislocation then go back. So, somewhere to what Vikas said, that earnings and then, some kind of re-rating that happens on the stock in this case is what you're looking for.
Okay, so price dislocation, that's the kind of dislocation you primarily look for.
Well, it's price dislocation because that's when you find the stock price significantly below what you think is the value. So at the peak of COVID, it was Bajaj Finance.
Got it.
Now, it doesn't come in as value because it was still trading at 3.5 times book at 1,900 rupees, but it wasn't trading at 1,800. 8 times book.
Right.
And that is price dislocation when it comes to that stock trading relative to its own history.
So it could be a commodity price move, it could be something intrinsic, a bad earning,
Absolutely.
It could be anything.
Back in 2012, it was Maruti when the strike happened.
All right, so what we'll do is we'll, just take a very short break on that one. We will come to Roshi as well because everyone's spoken about their story. We'll probably bowl a googly at Roshi and get her view on, what she learned from the investment mistake that you had made, because that is also something that teaches everyone about their investment journey as well. Take a short break, come back, we continue our conversations with the young guns of T Street.